So if I click on the risk reversal here, it'll take me to the detailed page and I can take a look at my returns. And hey folks, welcome back to the channel. So today I want to talk about a high leverage option strategy called a risk reversal. I'll explain what it is, when to use it, because it's not something you want to use all the time, and how to get out of a trade in case you want to close your position early. As you know, there's been a lot of volatility in the markets lately, so a lot of people are looking for downside protection, and they can do so by purchasing a put, which is kind of like insurance. It ensures that no matter what the stock price does in the near future, they are guaranteed to not lose money beyond a certain threshold. And this is where option sellers like myself come in. The buyer pays me an insurance premium, so I get money up front right away. Whether I will still be profitable or not in the end depends on how the stock price moves. If the stock goes down and reaches the strike price, then I'll have to buy the shares. Since the market and strike prices are the same, I don't really lose any money and I get to keep all the premiums, so my profit doesn't change. But if the stock price drops a lot, then I'll be at a further and further disadvantage because I'll be forced to overpay for the stock compared to what the market price is. And if the stock moves higher from the current price, well, nothing happens because I still keep the premium, but the option just expires worthless because there's no point for the option buyer to exercise their right and sell me the stock for a lower price than what they can get in the open market. So the profit and loss graph looks something like this for a put option. And you would normally do this on a stock that you don't mind owning, but it's maybe just a little too expensive right now. 95% of what I do with option is basically this strategy. But sometimes not only do you like a stock, but you also think it's underpriced, and there's a pretty good chance it could climb higher in the near future. If you have this kind of bullish sentiment toward a stock, then you may also want to buy a call option at the same time. This time you are a buyer of the option, so you have to pay somebody to sell you the call, which means right off the bat, you are losing money. You have the right to buy the stock at the strike price, but if it doesn't reach the strike price, then there's no point in exercising your call option. But if the stock price moves higher than your strike, then you can make a lot of profit after you recoup your premium. And if you do them both at the same time, the premiums will likely cancel each other out for the most part, and you get a graph that looks like this. And this is called the risk reversal. The reason you want to be extremely bullish on the stock if you're doing this is because you're leveraged 2 times basically with options. If the underlying stock price goes up a little bit, you're earning money from the put option losing value, and you're also earning money from the call option that's gaining value. And of course, the opposite is true as well if the stock price goes against you. So the best time to use this is when you see an asymmetric opportunity. So maybe a stock has been beaten down quite a lot lately, and you think it's oversold and will most likely go back up over the next couple of months. So assuming you like this stock and you've done your due diligence and you think it's really undervalued, then you can use this risk reversal to take advantage of this asymmetric situation. That's because your downside is fairly limited. Buying the stock you want at the price you want isn't necessarily a bad thing. And on the upside, your gains are technically unlimited. The point is you have a lot more to gain than you can lose. Plus, you've already decided that there's a higher chance of it going up than it going down. So as long as your fundamental judgments are sound, this could prove to be a very good strategy over time. So I'm going to share one example that I did with Lightspeed stock, so you can see my thought process in real time as I make this trade. So let's go back to January the 24th. All right, so today is January the 24th. It's a Monday and a lot of stocks are down. So you can see here, lots of red. So not a good day, but this could be a good opportunity to look at some options. Let's take a look at what Lightspeed is doing today. Down 11%. So that tells me volatility has probably increased, implied volatility. So options on this, especially if I sell put options, it is going to give me a higher premium. So that is good as an option seller. So I'll take a look at the Lightspeed volatility measurement here. I'm just using Alpha Query, this website. So one of the things that's coming up on February 2nd is the earnings report for Lightspeed comes out. So that's a little bit over a week from now. It's hard to say what the stock will do on that day. And there's like a 50-50 chance it could go up or down. However, I am more bullish on Lightspeed right now because I think the downside is limited. The book value of the company is at $18 per share. So it doesn't have too much to fall. It could fall to maybe 25, 22, maybe 20, but you're probably going to see a bounce somewhere around the low 20s. And because I'm pretty bullish on this company, I'm going to use a strategy today, an option strategy called a risk reversal. So I'll show you what that looks like. This is Interactive Brokers here. I'll just type in Lightspeed as a ticker, and let's open up the options chain for this. I want to go to the February 18th expiration date. As you can see, it's the one that's closest to expiring because I don't want to trade any long-term options with this stock. I'm really just trying to capture on February 2nd any large movement up. So I'm going to turn on Strategy Builder, which allows me to input multiple legs of the option. So maybe at 22.50, I will sell a put there. 25 is pretty close to the price already today. You can see just in one day it fell $3. So if it falls $3 again, this could go to 23. So I'm going to go instead of 25, I think 22.5 would be a pretty good option here to sell. I'm going to sell the put option on this and just add a leg here. That's going to add it down here. And at the same time, I'm going to go over to the call side and I'm going to buy a call option at, I'm thinking $30 because the delta is pretty decent for that. And if I hover over this ask column here and click on that, it will add a buy leg. And I'm going to set two quantities for this because I'm quite bullish. So I'm going to set the price of this to something in the middle, maybe like 50. So IB is telling me I'm doing a 22.5 and 30 risk reversal. And here is what the payoff graph looks like. So I'm going to submit that entry and it's going to go
Order
in here.
partially filled.
All right, so this is essentially what we have. I sold two put options with a strike of 22.50. For selling those options, I got paid $1.99 per option. And I normally just leave it at that. I just sell options and I make money and collect the premiums. However, this time I did something a little bit different, which is part of the risk reversal, which is to buy call options. So I have two call options here, and I bought them for $2.01. So the two almost cancel each other out, but not quite. You can see I still have to pay like 2 cents because here's the final numbers. In the end, it's $4 because it's $2 per contract. And then you add commissions on there. So that comes together to about $7 USD or 8.56 Canadian. And the profit and loss graph pretty much looks like this. And right now it's at around $26. So that's in the middle there. The orange line is basically my profit and loss. As you can see, between 22.50, which is my put option, and $30, which is my call, I pretty much don't make anything. In fact, I'm losing money. I'm losing $7 exactly. So that's how much money I will lose, just $7, if Lightspeed expires on February 18th, anywhere on this line here between 22.50 and 30. However, if it goes below 22, then I start losing more money. Roughly $18 is when I'm going to lose $1,000. So I don't think Lightspeed is going to go that low. For me, I think 22 or maybe $20 would be the lowest that it'll go based on fundamentals. And then if it goes higher than $30, then I start making money. Let's fast forward into the future and see what happens. Hey guys, it's Liquid here. It is February 1st. So this is about a week after I sold and bought the risk reversal. And we can see Lightspeed today is trading at 34.62. So it went a lot higher just in the last week. So that's pretty interesting to see. So looking at the 1 year chart here, it basically was the lowest point right there. If I zoom into the 5-day and go back to last week, January 24th, I believe I did the risk reversal around 12 o'clock or 12:15. So you can see it's right basically at the lowest point that's literally like perfect timing, which almost never happens. So this was just a complete fluke that I was able to time it at the very bottom. And a risk reversal is when you're super bullish on a stock and you want it to go up. So buy it at the very bottom. Who knows where the top is going to be, but it's definitely going in the right direction. So this is Interactive Brokers here. And if I go down to the Lightspeed risk reversal, and you can see what it's worth now, $1,160. So if you take what it's worth now minus what I paid for it, that so far that's the profit. And you can see the put now is worth only 45 cents, whereas before it was worth like 199, right? So it's actually gone down in value, which is good because when when you sell a put, when you're shorting an option, that's why this is negative, you want the option to go to zero, because that's the whole point. You want time decay to get rid of that option and for the option to expire out of the money. I just didn't expect this to go down so quickly, and part of the reason it is going down so fast is because the price of the stock is moving farther away from the put. So it's less likely for the price to actually be in the money, which is why this is worth less and less. And you can see my call option. This is the option that I purchased, right? So I want this one to go up. And you can see it's now a lot higher than what I purchased it at. I think I bought it at around $2, like $2.01. Now it's 6.25. And again, that's just because the stock price has gone up a lot. You wouldn't exercise a call option to buy the stock at $30, the strike price, if you can just go into the market and buy for 26 or $27. So that's why it was cheap before when I bought this. But of course, now, of course, you would exercise this. Like you can exercise this today and buy the stock for $30, go into the stock market, and then sell it for 34.62 and make 462 per share. Right. So that's just some easy profit there. And that's why this has more intrinsic value now, which is why it's worth more. I have two options. You just multiply that by 200 basically, and that's how much I can get if I sell this call and close the position. So if I click on this risk reversal here, it takes me to a detailed breakdown of my position, and I'm just interested in this your position here on the right. So it basically tells me the market value is worth 1,160 now. My cost basis is 7 because it takes a difference between my what I earned from the put option and what I paid from buying the call option. So because the cost basis is so low, the total return is a ridiculous number. That's almost 17,000% return. Now, keep in mind, this could have just as easily gone the other way, but let's take a look at um, the stock chart and what might happen tomorrow, because tomorrow is a big day. It is the earnings announcement. And usually, when that happens, the stock is going to move a lot, either up or down. I'm really glad that it broke its like long-term trajectory going down. So after earnings report, this could fall a lot. If it's like a bad earnings, and let's say the stock drops by 25%. Okay, so let's see what that looks like. It's at 34.62 right now. 25% of the stock price is $8.65. So if I subtract that from the stock price now, it could fall to $26 roughly. Not the worst case scenario, but I can certainly see it as a probable outcome on the downside. But if it falls to 26, then that's fine. In fact, it could fall to 25 or 24 because it doesn't really matter to me, how much it falls, as long as it doesn't fall, below 22 and a half, because that's sort of where it starts to really hurt for me, right? So from it to fall from 34 all the way down to 22, I don't think that's going to happen. That's a huge drop in one day, maybe in like a week, but in a day is very unlikely. So I think I'm pretty safe there. Okay, so let's jump forward 1 or 2 days to see the results of what the earnings look like, and we'll get an update from Future Liquid. Hey everyone, welcome to the future. This is the morning of February the 3rd, and the markets aren't doing well today. You can see the Nasdaq is pretty deep in the red. S&P 500 is also down. Let's look at Lightspeed. Yeah, down 5%. But you can see similar stocks over here, they're also down. So this tells me that it's not just Lightspeed that's doing bad today. So what happened yesterday was they had the earnings report. It was okay. It wasn't too much bad news. It wasn't good news either. I think it was pretty much in line with what people were thinking. So, like over the last couple of days, this swinged from like $34 to $28, and now it's around here. I think if it wasn't for the overall market being down so much, we would still be at around 33 or $34. Yeah, let's take a look at my risk reversal for Lightspeed. For the day, I'm down $420. That makes sense because the stock is down. So this is leverage to that. But the current risk reversal, so both my put and my call, if I open this up, it's these two prices here, the call and the put. If you combine these two, you get the total value of this risk reversal, which is $440. I probably want to close this early. I'm not so worried about the put option. I think that's probably going to expire out of the money. But the call option here, as you can see, it's a $30 strike. And the stock today is worth about $30. So basically, all of this $507 market value for this call option here is the extrinsic value. And one of the disadvantages to owning this call option is, of course, as time goes on, you have time decay. And every day, the price of this call option, the market value, will decrease. And there is a number we can use to know how much by looking at theta. So it's minus 0.076. So theta is how much the option's value will decline every day up to maturity. I think it's better if I close the position now and lock in my profits rather than make the assumption that Lightspeed, the stock price, will go up. Anytime you enter a position, you want to have an exit strategy. And my exit strategy, the plan was to just look at what happens after the earnings report. And if it was good, then I would probably keep it. If it's bad, I would lose basically $7. Plus, there's a possibility that I could get assigned because I have a 22.5 put option that I sold. But that was very unlikely. So overall, I paid $7 for this risk reversal, and I think I'm going to close it today. So if I just want to close one of these positions, like the call or the put, I can right click on this and then go close or roll if I want to roll it, but I probably want to close it. So I can close or I can just buy it or sell. But what I want to do is close the entire position. So I can right click on the top layer here, Lightspeed risk reversal, and I can click on close. And that's going to bring up this entry form here. And it's saying I want to sell because before I bought this risk reversal, I want to close two positions. Uh, there's my range of bid and ask. So I want to try to sell this for as much as possible. And this is per contract. So I'll be getting like around 400, 450 in total. I will choose a slightly on the higher side, maybe 240, and submit. So it's saying if this gets filled at the price that I want, then I will close this and make $477 after commission. So override and transmit. So that is going to add this order here. It's saying I want to sell this risk reversal with a limit price of this. You can see I did a Facebook or Meta put spread here. So this is a bull spread. Let's take a look at the trades here. Let's open this up. So Meta today is trading at $240. So that's quite a long ways away still. But I sold a put at $200 expiring next month, and I made $254 from the premiums. But I also purchased another put at 190. So I paid somebody else to sell me
Order
this put.
partially filled. Order filled.
Oh, and it looks like the Lightspeed risk reversal got filled. Anyway, I should finish talking about this. So I bought a put option at 190 and I sold one at 200. So why is this called a spread? Is because I'm going to make the difference between the two, which is $95 here was my total premium because I earned this much and then I also paid this much. And the reason I want to do a spread here and not just have a $200 put and that's it is because if the stock price goes way down for some reason, it goes to like 150. I'm only losing the money between 200 and 190 because I'm covered if the stock goes below 190. Okay, so it looks like my Lightspeed just filled, so that was pretty fast, and that was good. I'm glad it filled at the price I want, and I didn't have to adjust that. So it paid some commission here, but I was able to get what I wanted. So here's the final tally in the end. I purchased the covered call for $403, sold it at $543, and made a $139 profit. For the put option, I sold it for $396 to open the position. That's why it's positive. And then I bought it back at 63 because I paid money to buy it. That's why it's negative. So it's still buy low and sell high, which means I made a 333 profit. So altogether, that's like $472 in realized profit. And the stock price only moved up like a few dollars. And had I closed this position on February 1st before the earnings report, the stock price was a few dollars higher, and I could have closed that position and made like $1,100 in profit. So you can see how powerful this risk reversal strategy is. But you also have to be careful, because if the stock price goes down, then you have to be ready to buy those shares at whatever strike price you have set for the put. So like I said in the beginning, you don't want to do this all the time, but it could be a very useful tool in certain situations. You just have to be careful and know what you're doing. So thanks a lot for watching. I hope you got something useful out of this video. Happy investing, and until next time.